Hi guys, it's Stock Curry, and in today's video, we are going to go over the top mistakes to avoid in 2022. These are mistakes I've seen a lot of new retail investors make in 2021, and I'm going to go over some of those things and kind of tell you guys what to avoid in 2022 so that you can make a lot more money. In addition, we're going to talk about what's going on with the Tesla recall. We're going to talk about why all of the high growth stocks were up today and whether or not this is the bottom and they're going to start going back up and we're finally going to get that rebound on high growth stocks, or if this was just a dead cat bounce and it's just fooling everybody and it's a bull trap and they're actually going to go back down. We're going to talk about that. And then once we get through all of that, we're going to talk about your stock picks and we will cover whatever stocks you guys want to talk about. Now, this is the final video for 2021. So happy New Year's to everybody who's watching this video. I am so excited to be with you right now. Let's go ahead and get into the mistakes first and talk about some of those. And then we'll get into everything else, including all of the stocks and especially the high growth stocks and what's going on with those. Okay, so first of all, let's talk about some of the mistakes that I've kind of seen. The biggest mistake that I saw by far this year was people who were basically jumping into stocks too much of their portfolio. They're kind of YOLOing. So there was this whole, especially once the AMC movement started, there was a lot of people that came out and they just wanted to kind of YOLO into stocks. So I want to show this to you guys right now. I don't know if I can make this bigger or not. Let's see. Can I? Yep, there we go. Okay. So I want you guys to see something. So this is a screenshot from Chris Sain's video that he put up today. And Chris Sain was basically explaining how he lost $90,000 on one particular stock. And if you take a look at this, what you can see is he put 90% of his portfolio into AMC. 90%. I mean, that is what you call a YOLO. YOLO is YOLO. You only live once. It's when you just basically put all your money into one stock. And unfortunately, unlike Trace Trades, who started the whole AMC movement and bought it at the very bottom, Chris Sain bought near the top at $44.05. Of course, AMC isn't trading anywhere near that now. And Chris Sain is down 34% on this play. Because it was 90% of his portfolio, it means his whole portfolio is down 34%. So this is a good example of one mistake to make, which is don't YOLO. Do not go all in on one particular stock. Okay, that is one mistake that I saw. Now, another mistake that I saw was people getting FOMO, FOMO. And FOMO is basically where you have what's called a fear of missing out. And what that does is basically on FOMO, as a stock starts to run up, everybody wants to buy in. So we can pick pretty much literally any stock from earlier this year. I'll just pull up SoFi. And what you got, and there's worse ones. I don't know. Let's do NEO. NEO is a good example, even though it hasn't quite fallen as much as some of the others. Yeah, Smile Direct Club's been going down all year. I guess DraftKings is another one. But you see these stocks run up and then they run down. Let's see, LCID. I think that was kind of a good example earlier as well. So what happens is you start to see these stocks run up and you're like, oh, wow, this thing's going up so much money. I need to jump in. I need to buy it right now before it goes up even higher. And because you don't want to miss out on all these gains that everybody's making. So you have a fear of missing out. So you buy in somewhere up here in like 50 something dollars. And then the stock starts to drop and you learn, oh, buy the dip. So you buy the dip. You learn, oh, buy the dip. So you buy the dip. Oh, buy the dip, buy the dip. And instead of going back up, the stock keeps going down and down and down because it got run up too high too early. We can look at literally just about any other stock like that. Let's go back to DKNG here. It's another stock that ran up. People are buying the dip, ran up. People buying the dip, ran up. But eventually this just doesn't work. The price to earnings ratio gets too high. The valuation gets too high and these stocks start tanking. And So that's why if you go back and watch a lot of my videos from earlier, especially like a few months ago, you see me start saying things like, look, these are too high, they're going to come back down. And people are thinking, oh, it's never going to go down. DKG is going to $200 or, whatever people were commenting back then. But now, what is it trading at? $28. It did go down because stocks will always eventually get back down to the proper valuation. So if a stock runs up to massive highs and it's trading at a PE ratio of 500, like, or even what was ZM earlier this year? Pull it up. ZM, let's go. ZM was trading $588. And I think the price to earnings ratio at that time was like 5 or 600. That is ridiculous, right? So you're never going to see a stock go up 500-600 PE and maintain that. That is eventually going to get back down to a more realistic valuation. And that's what we saw so many times earlier this year. People had a fear of missing out. They were buying in once the stock was already overvalued, and then they just never made their money back. A lot of the stocks went down 50-60%, and people lost out. So that's one thing to kind of keep in mind. Another mistake is the exact opposite of fear of missing out. And that mistake, and I don't know, we can pull up maybe Tesla or Apple or something like that, because we have plenty of, actually, I want to get to Tesla later. So let me do Apple. Let me do the other one, which instead of fear of missing out is basically, it's panic selling. So I don't know what you call that, but panic selling is the opposite of a fear of missing out. It's when a stock drops a lot and you panic and you sell and you miss out on a ton of gains. So a lot of people did that last year, actually in 2020, when the stock market crashed. A lot of people were in a stock like Apple, and they just see the stock go down and down and down. They panic, they fear, they sell out. I mean, look at how much selling took place right here when Apple was trading at around, 50, $60. This is people that don't believe in the stock enough. They haven't done enough fundamental research. They got scared when the stock ran down too much and the stock was undervalued, and they sell out. And a lot of these people, unfortunately, just got out of the market. They thought, oh, the market's rigged or it's, no good or whatever. So they get out and they never get back in. And had you sold Apple here at 60, well, today it's trading at 178. So, I mean, that would have been a major, major mistake. So you had the dip here, but then if you zoom out, you just see it go up and up and up and up. And like I said, you can see this on pretty much any stock. If from a lot of times, oops, not that one, TSLA. So we take Tesla, for example. You had this run up back in February this year. A lot of people sold. It gets down by May. This thing went from $900 all the way down to $550, and a lot of people panicked. You might recall that I was actually buying TSLA at these prices. Every time it dropped below 600, I was like, buy. And especially when it got down here, I mean, I loaded up, and I'm glad I did, because look, TSLA went from this 50 to 1,000. So this is just the opposite of fear of missing out. Is people panic sell when the stock gets down too much. So how can you avoid these two mistakes? How can you avoid fear of missing out, and how can you avoid panic selling? And the way to avoid both of those is by doing your own valuation on the stock, determining what you think a stock should be valued at, and then holding true to that. Don't give up. If the stock drops below what you think it should be valued at, buy more. If a stock goes above what you think it should be valued at, take profits or wait for it to dip if you haven't bought in yet. So it's really important that you come up with your own valuation and you stick with it and you don't falter. Stocks almost never trade at fair valuation. Stocks almost always trade at a below value or above value. They swing up and down and up and down. They're constantly swinging between undervalued and overvalued. And so when you come up with a valuation on a stock, the next thing you need to do is buy when the stock is undervalued, sell when the stock gets overvalued. And that's how you can kind of swing trade back and forth on these. So a good example would be PLTR, which has been a great swing trade for the past few months because PLTR, we had this huge run up. And this is, when you see straight runs like this is the type of FOMO that I'm talking about. If you do valuation on PLTR, you can come up with whatever price you want to based upon future valuations. I personally think somewhere around 24 bucks. But what PLTR did is obviously this was overvalued, not the point you want to buy in. But when it starts to drop down to 17, 18 bucks, that's a great buy-in price. And when it gets back up to 27, okay, overvalued, sell it. Gets back down to 21, undervalued, buy it. Gets back up to 28, overvalued, sell it. Gets back down to 24, well, fair valued, let's just wait and see. Gets back up to 27, 28, sell it. Gets down to 17, 18, where it's at right now, buy it. So that is kind of how I've been looking at swing trading. Same thing with something like SOFI. So ran up to 25, sell it, gets back down to 14, buy it, sell it at 25, buy it at 14, sell it at 25, buy it at 14. You guys get the idea. So stocks are constantly swinging between undervalued and overvalued. And that's the key. Now, a couple of things about all of this. First thing is you got to kind of understand how to value a stock. So I see a lot of comments and questions here like, okay, can we just do a quick lesson on how to actually value a stock? What do you do? What is a PE ratio that you would buy a stock at? So these are all great questions. So I said I was going to do this. Let's just go ahead and do it now. Let's do a real quick lesson on how to value stock with a PE ratio. And hopefully I can knock this out in a very short period of time because this probably should be a good 30-minute video, but we will we'll give it a shot. So let me go to a new whiteboard here. And we will do how to value for a PE ratio. What is a good PE ratio? So first of all, when you're thinking about PE ratios, you've got to understand what the PE ratio is, what it is, why it's important. And the PE ratio is called a price to earnings ratio. Now, forget the stock market for a second. Just completely forget the stock market. And I want you to think about a business. Let's say you own a business and you want to sell that business. Maybe you guys have watched something like Shark Tank and you see people trying to sell their business and they're trying to figure out a valuation on the business. So when it comes to a business valuation, there's two ways that you can generally value a business. And first of all, when it comes to a business valuation, the two ways that you would generally value a business would either be 1 year's of revenue, or you could value it with 10 years of profits. So these are generally the two ways that somebody would value a business. It's either 1 year's of revenues or 10 years of profits. Now, when it comes to the PE ratio, that is in earnings. Earnings is profits. Earnings, profits, same thing. So to properly value a company, what you are looking for is 10 years of earnings. Now, 10 years of earnings would equal a PE ratio of 10, because what this is this is essentially what you're looking at is a PE ratio of 1, a price to earnings. So it's 1 year's worth of earnings. If a business is going to be valued off of 10 years worth of earnings, that's a PE ratio of 10. Now, you may have heard that a general rule of thumb is that a PE, general PE for a stock and a fair value is 15. So why 15 if you base a business off of 10 years worth of earnings? Well, the reason is because of growth. You expect the stock to grow. So let's say a stock grows by an average per year. Let's say earnings are going to grow by an average of 5% per year. Well, over the course of 10 years, that would be 50%. So if you add 50% to this, what you get is we'll do plus 5% per year growth equals 50% over 10 years. Okay. So then what you end up with is, okay. Back over here. Okay. So then what you end up with is you get your PE of 10 plus 50%, and that equals a PE of 15. So that's how people have historically come up with that PE ratio of 15 is supposed to be normal. Okay. Now, the question is, should all stocks trade at a PE of 15? And the answer is no, absolutely not. What I want to pull up for you real fast is we will look at the average PE ratio for particular industries. And what I'm going to do is I'm going to pull up FinViz. And if you guys don't know what FinViz is, it's a free website. You can do all kinds of different screeners and look at things. Well, what I'm going to do is I'm actually going to, rather than look at stocks here, we're going to go look at the industries. Okay. So a sector, if you will. And I got to remember how to do this because I haven't done sectors in a while. So give me 1 second. So ticker, sector. Okay. Well, those are larger sectors. Let's see. Sector. Okay, this is breaking down. This is not the crap. I can't remember how to do it. There was a way on here to actually look at the sectors by themselves without the individual stocks, and I can't recall off the top of my head how to do that right now, but whatever, it doesn't matter. Let me do this instead. So for whatever sector you're looking at, you can just figure out what the PE ratio should be. So if you literally go to Google, right, and you Google the average PE ratio for whatever sector you're looking at, let's say it's Tesla for, I don't know, the electric vehicles. So you could look at something like this, and you got electric car PE ratio, pull it up. It'll kind of show you your average. Well, Seeking Alpha is a lot better for this. Let's see. Oh, here we go. Here's some average PE ratios right here. So look at some of these PE ratios. All right. Well, that's old too. January 2021. Well, normally I do so. Let's do consumer goods because that one I know is a big one. Okay. So here we go. Average price to earnings ratio in retail sector. So automotive is 30, building supplies 152. You guys get the idea. You see these PE ratios? This is nowhere near 15. I'm sorry, you guys can't see that. Let me make this bigger. So these PE ratios are nowhere near 15. You guys kind of see what I'm saying? So just because a PE is higher, like, well, let's see. Tesla right now is trading at, let's see, SoFi is trading at, well, it doesn't have a PE because it doesn't have any earnings. But Tesla would be trading at a PE of 176. So let's take Tesla, for example. Is Tesla forward PE 176, current PE 347? Is that a good valuation? Let's go ahead and use this to figure out the valuation on TSLA. So here's how we calculate this. We're going to take the PE of 10, and then we're going to add the growth. So what is Tesla's growth rate? That's the question. So we go over to the financials, and we look at the annual growth rate. You can see the revenue grows. We've got 60%, 80%, 14, 28. So if we look at revenue growth, and we do the average of the last 5 years, you've got 28, 14, 82, and 68, basically. You divide that by 4, you have an average growth of 48%. Now, the next thing that we want to do is figure out what was that compound over 10 years, assuming that Tesla continues to grow by 48% per year. So what I'm going to do now is we're going to go over to Google again, and we'll try to find one. And we're going to go to a compound interest rate calculator. And I have no idea what we're going to end up pulling up here, but I'll try to find a good one that's fairly simple and doesn't get too complicated. Okay, so initial investment, we'll just do 1 to make that easy. Monthly contribution. So length of time in years, we're doing 10 years because we want it over 10 years. The interest rate, 48. So we'll do that. And annual calculation and calculate. Okay, so the 1 turns into 50. So that is going to be, if we do that, 50, turn that into a percentage, it's 5,000. All right, this is going to get crazy, right? So 50 where is your, where is it? Where is it? Where'd it go? Okay. Pull it up right there. Okay. So you're looking at a 50-time growth, technically, over the course of 10 years, right? Now, there's no guarantee it'll stay that, but let's just say it does. That would be 5,000 if 5,000. So you take your PE of 10 for the current PE, you add the growth, and I'm sorry, I did that wrong. So Tesla, technically, right, just fundamentally, and there's a lot of different ways to do it. I'm going to show you multiple ways right now. But if you look at that way, you could have a PE of 5,000 on Tesla, and in some cases, you might consider that fair value if you think Tesla will continue to grow at massive growth rates. Now, not all stocks will. Let's go and look at the earnings. So the earnings, the problem with Tesla's earnings is they're growing really fast. So they were at negative, and then we finally get 0.64. If we come down here, oh, you know what? I know what I did wrong. Crap. Oh, no, it's based on 40. Okay. So yeah. So the problem is if you look at this growth rate, look at this growth, 100% year over year increase in profit, 2,300% year over year increase in profit, 900% increase about four. So this is completely unsustainable. Okay. So if you guys understand, Tesla's growth right now is completely unsustainable. So Tesla is not going to keep growing at 45% every single year. They're not. The growth rate slows over time. So what you end up having is a 45% maybe, and then it drops down to maybe 30%, and then 20, and then 10 or 5, and then it starts growing slower. And if we go back and we look at the annual, what you're going to notice you have the 60, you have the 80, and then look at the last year. So we're down to 14, you're down to 28. So growth slows over time. And that's why Tesla's not trading at a PE of 5,000, because the growth is going to slow. It's going to slow down to 15, 20, something like that. So let's say you think that Tesla's growth rate over the next few years is going to average 15, which is probably a lot more reasonable. If we do that, and then we recalculate this, so now we have 4, right? So if you think Tesla's going to grow at an average of 15% per year, now you have 4, which again, if you convert this to where did my calculator go? If you convert this to a percentage, you end up with 4 times 100, which is 400. You add the 10, and now it's a PE ratio of 410. So if you think Tesla's going to grow by 15% per year, then Tesla should be trading at a PE ratio of 410. It's currently at a PE ratio of 176. So looking at it in those ways, Tesla's undervalued, right? It could rise another 2x over the next year. That's some of the things that you guys kind of have to look at that way. Now, there are other stocks like the ones I talked about yesterday that are extremely undervalued, that are trading at like 0 point something, that you might just want to stay away from because the future growth is negative. And those are kind of the stocks that are going down and kind of going out of business. So this is kind of how you want to look at a PE ratio. The calculation that you use to determine a PE ratio is going to be PE of 10 plus the average future growth over 10 years. Is basically the calculation that you want to run with. You get this calculation, you'll come up with a PE ratio that you think the stock should be trading at in the future. Okay, 10 plus the average future growth over 10 years. Now, for a lot of stocks that grow very slowly and they're growing 2-3% per year, it's going to be a PE of 15. That's going to be mainly your large caps, your Dow Jones Industrial Average stocks. For the NASDAQ stocks and a lot of the high growth stocks that have much, much higher growth, that are expected to grow by 10, 20, 30, 40% per year, you're going to have PE ratios that are really high, well over 100. So just because the PE ratio is 170 like Tesla is, does not mean the stock is overvalued. In fact, Tesla's PE ratio right now is actually undervalued. Tesla's undervalued right now. So it's crazy to think of, but this is something that a lot of short sellers got wrong last year. Is a lot of short sellers went out and like, PE ratio of 150, that's ridiculous. I'm shorting the stock. And of course, the stock just kept going up because people didn't understand that Tesla is going to be a stock that is going to be an absolute beast and they're going to grow like crazy. And the PE ratio is well justified. I talked about one stock the other day, and I can't remember what it was. It was, anybody remember the stock I talked about the other day at the PE ratio of 400? It began with an M, and I can't remember the name of it. It was this guy right here, MELI. There it is. So MELI currently has a PE ratio of 447. And like I said, based upon their growth, their annual growth has been consistent: 40, 18, 59, 70. This PE ratio of 410 is justified. So that's what I want to talk about with PE ratio. Okay, got that out of the way. Let's talk about a few other mistakes. And this time I want to get into options because there's a lot of mistakes people make with options. Now, I did an entire kind of options course a couple days ago. You guys can go watch that. It's how to make a ton of money in options. And what I want to kind of point out with that course is this. I'm just going to reiterate some of the things that I talked about in that course. Let me pull it up so you guys can see what video I'm talking about. Make sure you guys get the right one. It was another live stream, actually. So give me 1 second. We'll get past this. I had to get past a little ad here. All right. So this is the course right here that I put together, is how to make a ton of money with options. This video actually goes through and explains a lot of mistakes people have with options. A lot of people will buy a straight call option, whether it be a single call or a single put. And the problem with that is, like I kind of explained, is when you are buying a single option, just a call, just a put, that option has to either go up a lot or go down a lot. And depending on how far out of the money you are, the option has to go up by, in a lot of cases, so much that the odds of making money are extremely slim. So if a call option, generally, if you're very close to the money, you will still only have about a 20% chance of making money on that call option. And if you go further out of the money, your odds of making money on that drop to like 10%, 5%. It's an extremely low chance of actually making money on buying a call option or put option. So a lot of mistake that a lot of new investors make is they think a stock is going to go up a ton because everybody's talking about it, and they buy a call option and then they lose everything because the call option didn't actually pay out. So that is another big mistake with options. If you're going to do options, the way to make money is by selling options. Because think about this: if an option has a 5% chance of making money, the seller of that option has a 95% chance of making money because he sold you the option. If the option has a 20% chance of making money and you buy it, well, guess what? The seller of that option has an 80% chance of making money. He sold it to you. And so buying single leg options is one of the biggest mistakes that I see new investors make. Don't buy options, sell options. You'll make way more money when you sell an option. Now, if you don't understand multi-leg options, that's okay. There is a very simple way to sell options. And the two very simple ways to sell options is with covered calls and cash secured puts. A covered call and cash secured put are both bullish. And what they do is, if you have 100 shares in a stock, rather than just waiting for the stock to slowly rise, you can sell an out of the money call that's way out of the money, way high. You will collect the premium, and you'll have an 80-90% chance that the option contract will not go through because your stock will not get above the price of that actual option contract, above the strike price. And so you can actually make money by selling covered calls. And so as your stock slowly rises, you'll make money as the stock goes up, and you'll make money on the options that never get exercised because they're always out of the money. The other way to make money is with a cash secured put, and that's if you don't actually own the stock yet, but you want to buy the stock, but you'd rather buy it on some sort of dip. On a cash secured put, you're going to buy it, or you're going to sell an out of the money put option, And if the option gets down to that price, you basically are able to buy the stock at a huge discount. And if the option does not get, if the stock does not get down to your option price, then you just keep your premium and that's it. You're done. You just made money. So those are two ways that you can make money. Now, somebody said that you can't do puts or calls in the UK. And if you're on something like, trading 212 or something, that might be the case. But in the UK, you can do other types of derivatives, is what they're called. And so I can't think off the top of my head what those are called. Let's see. I'm going to Google this real fast, see if I can remember it off the top of my head. It's called it's not a CFD. That's what it is. So you can trade CFDs if you are not in the United States and you can't trade options. A CFD is really similar to an option, but a CFD works a little bit different. In a CFD, it's a contract for the change in price on the underlying asset. With an option, it's also a contract and it also moves in the change of price. The difference, though, on an option is at expiration, if you choose, you could actually buy or sell the shares depending upon whether you have a call or put option. With a CFD, you don't have anything tied to the underlying outside of an agreement, a contract that you are going to trade what's called a mark to market on the price movement of the underlying asset. So if you're in the UK, you can't trade options. Just know you can trade a CFD, which is very similar to an option, but it does carry a little bit more risk. Okay, hopefully that helps you guys out. Now, that is all that I wanted to cover as far as mistakes that I see people make in the markets, the biggest mistakes anyway. So what I want to do real fast is just go through your comments real fast. I want to make sure we didn't miss anything. And then we're going to talk about Tesla. We're going to talk about the high growth stocks, and we'll talk about your stocks. So give me 1 second to review the comments. All the high growth stocks that are down, a lot of them are value plays. And in just a minute, we're going to talk about whether or not now is a great time to buy in. So I just want to explain this real fast. A lot of people said, why do you cover Chris Sane, Stockmo, all these other YouTubers? The whole point of my channel is to cover the other YouTubers. One thing I want to do is just go through and kind of make sure that I kind of give a voice of reason to the other YouTubers, and also sometimes some alternative thoughts, alternative viewpoints. A lot of people watch these other YouTubers. I know the other YouTubers watch me as well. And what I like to do is just give some alternative viewpoints. A lot of times I agree with them. A lot of times they have great trading ideas and great stock picks, and I want to let you guys know about those. But at the same time, if they say something that I don't agree with, I want to let you know that as well. We don't, it's good. It's really good as a teacher to have somebody, reviewing you and giving some alternative viewpoints and opinions. And it's also good as a teacher to listen to those criticisms, if there are any, and to change and get better and improve over time. So that's the reason why I cover the top YouTubers, is just to provide more insight, let you know what they did really well, let you guys know what I disagree with. And that way you can have a little bit of more information when you're trying to make your own decisions on what to buy and what to sell. Okay, let's look at a few other things. Okay, so here's a good question. So LCID went from 16 to 62 in a matter of days. When would you have bought it, and when? Okay, so let's talk about what I actually did do on LCID. So come on, LCID. Okay, so what I did on LCID is I actually bought it right around here, right when it was trading flat around 18. This is where I bought in. Now, I actually sold a little. I bought in around 18. I sold around 30 something, somewhere in here. When it was trading around here, I sold some of the LCID because I wanted to get rid of my initial investment. And then I held as it went up. and I was super excited. I thought this thing was going to rise, and it just tanked, and I kept holding. And then, but I was house money at that point, right? It was 100% house money. I had taken out my initial investment already, and then I sold. I don't remember. No, I didn't sell this. I think I sold like the next day. Anyway, I sold the rest back in the 30s as well, low 30s, high 20s, somewhere around here. And then I didn't buy back in at all until this day right here. So this day is when the lockup expiration occurred for the pipe investors. And this is where I bought in a bunch, and then I sold like a few days later around 20. But those are the only trades that I've made on LCID. And yeah, I totally missed out on this. Well, I didn't totally miss out. I can't remember where it was. Something was happening. Oh, they were about to release their first car around this time. I didn't buy the shares, but I did buy a call option on LCID, and I ended up selling that call option. I think it was like this date right here, a few days later. Made a little bit of money on it. Of course, had I held the call option, I would have made a ton more money. But I didn't know. I thought we were going to get a one-day spike from the new release, and then we're going to go back down. I didn't know it was going to keep running up. But when it got up here, what did I do? I put out a whole bunch of videos talking about it was overvalued and it was time to sell. And a lot of other YouTubers, including Larry Jones, Zip Trader, they all said the same thing. They're like, sell this thing, it's overvalued. And so now LCAD is coming back down. Do I think LCAD is at a fair value right now? No, I still think this thing's overvalued. I would not buy it until it got down below 30. I think this will keep going down. I still think this thing is overvalued. They're just not producing enough cars to actually make this valuation worth it. Now, aside from the cars, they do have great battery technology, and they are starting to sell their battery technology to other manufacturers. So that is the one thing we're going to have to look at. If that battery technology ends up providing a ton of revenue for LCAD, then I'm going to have to rethink my valuation on this. But right now, I don't like this thing until it gets back down below 30 and down into the 20s. Okay. Let's just see if there's anything else as far as PEs or any other questions. Oh, okay. This is another thing I want to put up. So buy low, sell high. Everybody says, oh yeah, it's easy. Just buy low, sell high, done, right? Done. Okay. If buy low, sell high is so easy, then why is everybody getting mad at Germany with Financial Education for buying all these dips? You got, what did he talk about yesterday? It was, he talked about PLNHF, which is dropping. He's buying. He talked about AVTBF, which is dropping. He's buying. He's got all these stocks that he's buying that just keep dropping. Guess what? That's how you buy low and sell high. When everybody else is fearful, when everybody else is panicked, when everybody else has gotten out, this is when you buy in. You don't buy into AVTBF when it's run up like this. This is the FOMO buyers, the fear of missing out buyers, the buyers that are going to get absolutely screwed when this thing finally gets back down to a good valuation. When you buy in is right here. This is where you buy in. When it's already beat down, when it's dropped a ton, this is how you make millions of dollars in the stock market. You buy these stocks beat down super low. This is when you buy. Same thing with PLNHF. You don't buy PLNHF when it's up here trading at $8. You wait for this thing to drop down. It's down here, $2, $8, $3. This is when you buy in. So Germany with Financial Education is buying low, and I guarantee you this guy is going to make millions and millions of dollars off of these plays over the next 5 years. Guarantee it. So you say buy low, sell high is easy, but for whatever reason, retail traders do the exact opposite. They see the stock falling like this, they sell out, they stay away, and then when it runs up, they buy. Don't buy high, sell low. Do the opposite. Do what Germany with Financial Education is doing. Buy them low and then sell them high. So, yeah, you're absolutely right. That's the way to do it. Buy low, sell high. But is it easy? No, because it goes completely against what you like psychologically want to do. All right. So, Paul, you make a good point here. Goldman Sachs has a PE ratio of right now 6.4. Citigroup's even lower with a PE ratio of 5.8. Banking stocks should do extremely well next year. Certainly, these are really good ones. Let's see. So SoFi we already talked about. Um, okay, what I want to do right now is, well, we'll just address this and then we'll get into Tesla and the high growth stocks. So marijuana stock, or first of all, Rich, thank you for the super chat. Marijuana stocks are beat down. Is now a good time to buy in? Any legislative catalyst coming up? So there's no legislative catalyst coming up. If there were, the marijuana stocks would not be down. They would be trading it at super highs. The reason they're beat down right now is because there are no legislative catalysts coming up. Again, making them a great time to buy. So now would be a good time to buy. But since we have no catalysts coming out, I wouldn't do options on them. I would just buy the stock and try to find some that you think are good. Okay, let's talk about TSLA real fast because I got to talk about this. We've got to talk about. I keep doing that. Okay, we've got to talk about what happened today. So I don't know if you guys saw any of the news on TSLA today, but basically what happened is there was 2 recalls that they came up with today, and one of the recalls was on the Model 3, and the other recall was on the Model S. So essentially what happens with these 2 recalls is, let me pull up my notes real fast so I don't forget. So the Model 3 recall, the way the news made this sound is the news came out and it basically sounded like this was a major safety issue, that it could cause crashes, that it could cause people to die. I mean, this is major issue. Well, Tom Nash dug a little deeper and he actually pulled up the actual recalls and read through them. Okay, guys, the recall on the Model 3 is for the rear view backup camera, the rear backup camera. And the only problem is that as the car gets older and as the trunk gets opened and closed a bunch of times, the cable that connects the rear camera to the center console can get disconnected. And so the recall is because the rear view camera might not display on the center console. I don't know about you, but my car doesn't have a rear view camera. If I want to back up, I just look out my rear view window, or I check my mirrors a little bit. Like, come on. I mean, what is the crash risk here? That somebody doesn't look behind them when they're backing up and they crash into a car behind them? I mean, maybe, but is it any surprise that this has literally resulted in 0 crashes? Because I think people are smart enough to look out the rearview window. Like, come on, guys. So the media made this sound like this is big deal. Like, seriously, in 1% of Model 3s, the rearview camera will stop displaying on the center console. That's it. That's the recall, okay? It's not a huge safety risk. It's not a big crash risk. That's it. The Model S recall was a little bit more significant, even though it seems to have gotten blown over by the media for some reason. But on the Model S one, the front trunk, the frunk, I guess you call it, that does not always latch all the way. And this actually occurs on 14% of the Model S. So what happened is that the front hood is just not closing all the way. And what happened is a year ago, some guy was driving down the road, the front hood, flew open while the guy was driving down the road. He pulled off to the side of the road safely, no wreck, no crash, nothing. Since that time, 5 more times, the front trunk has not closed all the way, but in 0 of those times was the vehicle actually in motion. It was just somebody that put some groceries or something in there, closed it, and wouldn't close. So this has occurred 6 times, only 1 time while somebody was driving, and there have been 0 crashes. So are these really big deals? No, they're really minor deals. There's no big crash risk to this. I mean, it's ridiculous what the media was reporting. Reality is very minor thing. Regardless, when the news came out, the media started reporting it in the pre-markets. You saw this huge drop, and then people are like, wait a second. They start reading the reports. They realize the whole thing is just ridiculous. And you see Tesla rose up to almost $1,100 today before it pulled back along with the overall market later in the hours. So that's kind of what's going on with Tesla as far as that whole recall thing. It's no big deal. You saw a lot of people talk about it, but really, it's no big deal. Okay, the next thing that I want to point out is this. Tesla right now, I'm going to turn off the EMAs real fast. I think it's this button here. What I want to point out on Tesla is that we have a long-term trend line that Tesla has been focused on. This goes back a long time. I'm not going to show you the whole trend line, but this blue trend line is a long-term trend line on TSLA. But what I'm noticing more in the short term is we have this downward trend that's started to form. So this is kind of a swing in the downward direction. You got a bounce here and then a bounce here, came back up, starts going back down. So in the short term, Tesla is trending downward. I think we'll get another one of these where it kind of comes down. And if I were to extrapolate this line out a little bit more, it looks like what's going to happen is TSLA is going to meet the long-term trend line down here at around $850 or $860. At that point, I think it'll bottom out and start going back up. So technically, I think TSLA is on its way down to around $850, $860. And then after that, I think we're ready to start going back up again. Okay, the next thing that I want to talk about is the high growth stocks overall. We saw high growth stocks today. A lot of them just ran up a ton. So SoFi was up 10% today. Let's see. Lucid was up 4% today. NEO was up 14% today. Let's see what else. DKNG was up 7% today. I don't know. I could just go through these all day long. It was ridiculous. This AVTBF that the German Financial Education has been buying, it was up 20% today. But wait, it was actually up over 40% today before it pulled back. Just crazy rise in price here. So what is going on? Why were all of the high growth stocks up today? So you got to understand that we are at the end of the year. And as we approach the end of the year, people are going to close out their positions. Now, the problem is this. The problem with positions is you've got short sellers and you've got people who are long. So as people close out their positions, the short sellers, when they close out their positions, you're going to see the stocks rise in price because they have to buy them back. The high growth stocks that a lot of retail investors have been invested in all year, those are the ones that have been beat down, that have been heavily shorted. And so as short sellers go to close out their positions for the end of the year, those are the stocks that are going to rise in price the most. So I think what you saw today was a lot of short sellers closing out their positions, which is great, but I've got a big warning for you. I went and looked on Fintel and I verified an Ortex and I looked at a whole bunch of these high growth stocks. I looked at AMC, I looked at NEO, I looked at SoFi, I looked at all these high growth stocks that went up quite a bit today. And I found something very interesting. The shares that have been borrowed were not returns. So short sellers cover the positions, but they're still holding on to the borrowed shares, meaning they can re-short those stocks anytime they want. So I think what actually happened today is we had these shorts cover, but the shorts are still holding on to those shares that they borrowed. I think they're going to re-short these stocks probably on the first day of January. It would be my guess. So we've got to keep that in mind. This is something we've really got to look at and watch out for and pay attention to in case, in case that does in fact happen. Keep in mind that the wash sale rule does not apply to a lot of the large institutional investors. The wash sale rule is really just, it's a rule for retail investors mostly when it comes to your personal taxes, but professional traders don't necessarily have that wash sale rule. So they don't have to wait 30 days to re-short or rebuy. So keep that in mind. Now, as far as what's going to happen tomorrow is the very last day of trading in the stock market. And generally speaking, most of the time, the market is down on the last day of trading. The reason is because people are trying to do tax loss harvesting. And they're going to wait until the very last day of trading before they know how much they actually have to sell in order to tax loss harvest. And so a lot of selling is probably going to take place around now. If you're going to tax loss harvest, you have to sell stocks that you're down on. And what stocks are down the most this year? It's your small caps. And where are small caps mostly residing in? They're residing in the NASDAQ and they're residing in the Russell 2000. So if we take a look at a Russell 2000 ETF, we will look at IWM. IWM is a Russell 2000 ETF. Let me pull this up on the screen for you. Okay, so we are taking a look at the IWM Russell 2000 ETF. And what I think is going to happen tomorrow is we're going to get a red day, probably down around, I don't know, we'll say 220, something like that. And if we take a look at what happened today, we had this run up. It was running flat all day long. And then, really, in the last hour of trading, it absolutely tanked. And I think a lot of that is because people expected tax loss harvesting tomorrow and they expected the stock market to go down tomorrow. And so the traders wanted to get rid of these stocks before tomorrow. The same thing happened in the NASDAQ. For the NASDAQ, we can take a look at the QQQ, which is a NASDAQ ETF. Let me pull this guy up here for you. And you see the exact same thing. It ran up, traded flat for most of the day, and then dropped in the last hour of trading. Now, I didn't know it was going to drop this much in the last hour, but I had the same viewpoint that pretty much a lot of other people had, that the NASDAQ and the Russell were going to go down on Friday. So I'm going to show you guys a trade that I made today. And I apologize, the account is really small right now because I pulled out thousands and thousands, I don't know, $14,000, $15,000 I pulled out to kind of cover bills and expenses while my wife had the baby. So we're down to, actually pulled out another 1,000 today. So it's been going down, but regardless, still made some money this week. But what I want to show you is this guy right here. So I bought an IWM put 1 hour before close, and I'm up 108% on it. I bought a QQQ put 1 hour before close. I'm up 63% on that. So I told you guys for the past couple of days, we'd probably have a red day on Friday. And this is the trade that I made. I bought a IWM Russell 2000 ETF put and a QQQ NASDAQ put, and I'm up 100% on one and 63% on the other in 1 hour. By the way, if you guys want to know everything I'm buying and selling, you can just follow me on Twitter. I post all my buys and sellers free of charge. You just go to twitter.com/realscottcurry, follow me, and you'll get every single stock I buy and sell free of charge. Okay. Before I go any further here, let me see. Yeah, the 40% short interest, just real fast, guys, kind of explain that real fast. The short interest that you see in a broker, such as Webull or TD Ameritrade, Fidelity, Charles Schwab, anything like that, that is based upon the biweekly short interest. That gets reported on the 1st and 15th of each month. Well, a little bit after that, but it's based upon the through the 15th, through the end of the month from the prior month. And the problem with that is it's set, so you don't get any updated information. That's why I like to use Ortex and Fintel, because Ortex and Fintel give me updated information beyond just an update every 2 weeks. There was a glitch from the actual reporting agency that sent out a bad number to pretty much every broker. So it had nothing to do with your broker. It actually had to do with a glitch on the reporting agency. The true short interest a couple of weeks ago was not 40%. It was like 15%. So that was just a glitch. Another question here. Do we must sell with loss to cut the tax if we are keeping for the long term? So if you want to do tax loss harvesting, but you still want to hold your stock long term, yeah, you would have to sell it, and then you have to buy it back in more than 30 days. So whatever, let's say you're up $10,000 on the year, you have a realized gain of $10,000. If you want to pay zero taxes, then tomorrow you have to sell losses that are worth $10,000, and that'll even you out so you don't pay any taxes. If you want to kind of rebuy that stock for a long-term hold, then what you're going to have to do is you're going to have to rebuy it 30 days from now, or basically on February 1st. So just up on that. Another question here is, thank you, Rick, for the super chat. VXX, UVXY are both very low, worth grabbing and waiting. So one thing that you need to know about any inverse ETF, and this could be UVXY, this could be SPXU, this could be literally any inverse ETF, is that these are designed to go down over time. The reason is the maintenance costs on these are extremely high, and so they lose a lot of value over time. I'm going to pull up the monthly chart. It's going to blow you away. This is the monthly chart on UVXY. Today it's trading at $12. If we go back, this was theoretically when it first started trading at $997 million. So in the last 10 years, UVXY has gone from $997 million down to $12. So just to let you guys know, you do not ever want to hold an inverse ETF for more than 1 week. If you hold it for more than 1 week, there's a very good chance you're going to lose money. So no, I would definitely not grab and wait and hold on an inverse ETF, whether it be VXX, UVXY, SPXU, or any of those, because you will lose a ton of money. Okay, the next thing I want to talk about, let's see, we've covered Tesla, we've covered the high growth stocks, we've covered tomorrow. Oh, that's everything. We've covered everything I wanted to talk about. So we got a few minutes left. Let's see if there's any other things that you guys want to talk about. I got another super chat here. Rach, thank you so much for the $5 super chat. Do losses on options count against gains on stocks? Yes, they absolutely do. So your losses and gains, it doesn't matter if it's in futures, it doesn't matter if it's in crypto, it doesn't matter if it's in stocks, options. All of these things are going to be counted. Okay. So whatever you have losses on, keep in mind that when you pay your personal taxes, it's basically you're looking at your total gains on all of your investable assets and capital gains. It doesn't matter what that capital gain is from. It doesn't matter if that capital gain is from stocks, real estate, doesn't matter. Your capital gain has to be offset. So if whatever it was, crypto, stocks, options, futures, real estate, you would have to sell any of those to kind of offset the capital gains. Okay. So that's kind of what we're looking at there. Let's see what other questions, whatever we got. Neo, we've already covered. We'll talk about AMC real fast because I've seen quite a few people ask about AMC, what's going on with that. So again, AMC is not a fundamental play. So I can't really look at it from that point of view. So we'll just look at the technicals real fast. First of all, this is one of the stocks that I think some people might be down on, that might see some tax loss harvesting tomorrow. On the other hand, it could go up with some of these short sellers covering. I don't know. Short sellers lost a ton of money on AMC this year. We could see quite a bit of short seller covering tomorrow. So a short seller tax loss harvesting would be to buy the stock, right? So we might see AMC rise tomorrow as short sellers cover to do tax loss harvesting. I don't know. We'll have to see. But technically AMC it's kind of neutral right now. It's really neutral. The RSI is near 50, which is neutral. The MACD is at 0.5. It's pretty neutral. The EMAs are kind of sort of hovering around the 10-day EMA. They're above the 300, but below the 21. It's really, really neutral right now. Very, very, very difficult to see where AMC is going to go. I've already said I had to sell when I got rid of like pretty much everything a couple of months ago when my baby was born. But I am planning on rebuying here. If I was just looking at this from a technical standpoint, I would wait for a little bit more confirmation. The green line here is the 21-day EMA. I would want to see a close above the 21-day EMA. Basically, a close above $30. We get a close above $30, and I think that'd be a good time to buy back into AMC for me. Okay, let's see what else we've got that people might be talking about, more than one person. Yeah, good point. I knew I screwed that up. So Smart, thank you so much for fixing what I screwed up here. You're absolutely correct. That's where I screwed it up. I used the compound interest on the 15% per year. So you're right. It should have been 150%. You add 10, that gets you to 160%. So you're right. The PE ratio on TSLA should have been 160, not the whatever I came up with. I knew something was wrong there. It's a problem with live videos. I can't fix it. So we're trading a PE of 176. PE should be 160. So a lot closer. So thank you so much for correcting my mistake there. You're absolutely correct. Should have been added, not compounded. So thank you for that. Let's see what else we've got. Yeah, I just went over AMC a second ago. Let's see. Okay, we'll just talk about two more real fast. We'll do DKNG and FUBO, and then we'll end it. So for DKNG, what we have is, I said DKNG was getting kind of down. Now the price to sales ratio is 15 right now. 15 is still high from if you're, a value stock would be trading at 4. This is at 14. So the price to sales ratio is still quite high. But if the growth is there, it might be worth it. A lot of high growth stocks will trade at around 15 on the PEs. We're running what, 40%, 90%. This past quarter, 100, 200, 300. Yeah, I think this is undervalued. This should be trading at a price of sales of 15 or higher, 15 to 20, I'd say. I think DKNG is undervalued at this point. We are kind of hovering here at around this technical support level at around 28. And the only problem is the candles are still bearish. So I'd say DKNG is one I'd get on my watch list. And once we get some sort of confirmation of a rebound, we start getting the candles closing above the 21-day EMA. This would be a stock I'd love to buy into. DKNG undervalued, and I think we will see this go back up. So that's my opinion on DKNG. The last one that I will go ahead and cover is FUBO. Let me see if I can find that one. There we go. FUBO. Let's talk about this one real fast because this is one that I know a lot of retail traders have talked about. They're still in. Gosh, I mean, look at this. This ran up. Here's your FOMO buying to 62, and then it tanked. I remember looking at the stock back when it was around right here, and I saw what was called a head and shoulders pattern. Head and shoulders, when you get kind of this rise, and then the head, you come down, you get another shoulder, and usually it drops. I think I had done like a small put option on it around this price and kind of got this from like 23 to 18, kind of captured that price on it. But since then, it traded flat for a long time, but now it's going back down again. So let's take a look at it. I haven't looked at the stock in a long, long time. The price to sales ratio is 3. So the first thing I want to say about the price to sales ratio being 3 is because it's under 4, this is a value stock. So FUBO is a value stock. Let's go look at their growth. Their annual growth, not good, not good. And then we have a 5,000% growth. Well, that doesn't count because they had no sales. So we really got to go look at quarterlies. We'll ignore that. So really, we got about 200% growth, 150% growth. Growth is good. Unfortunately, earnings has been kind of increasing a little bit, which is not good. But the revenue growth is there. They can turn earnings around if they've got enough cash. Let's go look at their cash. They got $393 million in cash. Let's go look at their debt. They got 0 short-term debt. Long-term debt's $312 million. So $312 million in long-term debt is a lot. That's really going to hurt them in next year when interest rates rise. But they've got $393 million in cash, so they could pay off the debt if they need to in order to lower their interest rate. The only problem that I would really be concerned about is share offerings in order to get more. So they've been doing quite a bit of bonds, which is okay. They haven't really been increasing those. It's just been maintaining. As far as the issuance of capital stock, we have 78 million that was issued. Okay, their market cap is 2.33 billion. So really 78 million is a really small amount. It's probably just, taking care of employees. So overall, in general, I'd say FUBO fundamentally is a value stock. And I think from the fundamentals, it's a good stock to buy. Now let's take a look at the technicals. And we can see the technicals here. This is an absolute falling knife. We have the candles below all of the EMAs. The MACD is pretty flat. The RSI is, kind of low, rising a little bit. But generally speaking, this is the thing as a falling knife. So fundamentally, it's undervalued, but it could continue falling. And we don't know how low it could fall in the short term. So this is another one like DKNG that I would get on my watch list. And once it closes above the 21-day EMA, we get that confirmation of a rebound. This is one I think would be a good one to buy into. Okay, that's going to end it, guys. I Thank you all for joining us today. Thank you guys so much for being with me. We've been on here for over an hour. I hope you guys got a lot out of it. I apologize about messing up the PE ratios earlier, but hopefully the fixed explanation helps. I will be back with you guys next year. So this is the last video for the year. Before you go, if you could please just make sure you hit that like button and subscribe. If you're on YouTube, go ahead and click the bell icon and then click all so that you can get notified when I release my next video. If you guys want to join the free Discord, I actually created a brand new free Discord. We've had over 300 people sign up in the last 2 days alone. You just go to stockcurry.vip/Discord. You can apply to get on that free Discord. Everybody who applies will get approved. The only reason I have the application is to prevent scammers. That's literally the only reason that's there. If you guys want some training without the mistakes, you can go to stockcurryeducation.com. And for anything else you guys want to look up, stockcurry.vip is the website. All right, guys, I hope you have a lot of success trading, and we will see you next year.